because Newbie and I refused to use the title co-founders. And
Mhm.
then I'm like, I'm just a community manager. Um,
Yeah.
and then she'd be like, no, 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 but you don't do community management. I'm like, I know, but we do everything else. Um, but for everybody who's just joined, my name is Joe Kinvey, and I am one of the community managers at Hope. And today we're here with Peter, Peter Orifo. Peter, please correct me if I'm butchering your
Yeah.
name literally.
Yeah. No, you're quite REIFO.
Yeah, Orifo. Peter is the principal at We Capital. And Peter, instead of me going into your intro, I think it'll be great to just hear from you. And the purpose of this, AMA is like we came up with a earlier this year, and it's to kind of invite people like yourself to talk about topics that we believe that the community really cares about. And one thing that has been coming up regularly is valuation, right? So at Hope,
Yeah.
we've been investing from like I think we've done as early as like angel checks to Series A, and in between that, there's a lot of things that happen. And instead of me trying to do or give this talk about valuation, one thing that I've heard over and over again is, and I've actually experienced it, is valuation, depending on the stage, could be art, it could be science. So, I think we're all very keen to learn a bit more about that. So, Peter, without any further ado, over to you. Please, if you can, start with a brief intro and then take it away.
Yeah, sure. This is Peter. I'm principal at Recapital. Been at Recapital now since 2019. I've spent most of my career as an investment banker, just on financial institutions and fintech. So pretty much everything around lifecycle bank, buying banks, selling banks, starting banks in the US. Started to move more into fintech, kind of when I kind of had the opportunity to work on the first sale of a bank to a fintech ever in the US. And that's kind of like very quickly where I started seeing how such was kind of just reshaping financial services. And then left bank, spent time as a valuation consultant at a boutique consulting firm. Kind of sitting right in between startup founders and startups and investors. So, in that remit, doing valuation on pretty much everything from, just managing a cap table, managing valuation for companies. So like some of my clients were like WeWork, Vroom, Toast, like basically working on valuation all the way from seed through to like IPO. And then also too on the other side of the table, working with investors to just kind of think about how they were managing valuations in general. So like on that, working with like a SoftBank, a Google Ventures, et cetera. And you kind of get to see how two different sides of the table think about valuation, because it affects a number of different things too. Like it's not even just about raising money and whatnot. Like they're going to issue options, employee ownership plans. Like it runs all the way through, and there are certain things of provisions where it comes into play when you're doing the IPO. Even what you've been issuing options at, there's like a whole rule around that. But yeah, so kind of really wanted to do something closer to home, originally from Nigeria. And yeah, African VC just kind of became this thought experiment. Like, what would it look like if you took all these tools, resources, network, et cetera, and try to apply it in the market where I think, VC was still kind of nascent. And then just also kind of help, promote and just sort of, build Africa that we all deserve, just kind of cultivated through the mobilization of venture.
Awesome. I don't know if you I don't know how you want to start. I don't know if you have some sort of like a flow. I think it might be worth maybe just starting with like, what is startup valuation? What are the various stages? And
Yeah. So I mean, valuation really, the way I tend to kind of think about it is that valuation is determined, I guess, if we're thinking about it from like the accounting kind of like definition perspective, like value that's placed on a company by a third market participant, right? So if something, a share exchanges hands at a given price, right? That establishes a valuation. So let's say like, okay, I bought a share of, I don't know, Coca-Cola, right, from you at $1, right? And someone wants to offer me $10, right? A third party market participant that doesn't, with asymmetric information, so like doesn't has imperfect information, is willing to pay $10 for that, like that establishes a new market value. And I think in startup world, valuation is interesting. It means different things to different people. I think from the thing that I always tell like founders I work with is that like valuation, first of all, especially at the early stage, is a supply and demand contract, right? If you have excess demand, right, that kind of push valuation up, and if you have kind of like limit supply, i.e., like you're trying to raise, you have a finite amount that you're trying to sell, right, in terms of equity ownership in a round, that also kind of like sets the tone around things. Like, for example, if you're like, for whatever reason, like, oh, I can only give up 10%, right? Like the lower your equity sale, right, the higher it's going to push up your valuation. And I think the founder, like as a founder, you want to kind of strike this balance between get an innovation that's kind of commensurate to like where you are, what you're doing. And sometimes we'll see people try to like index off of like benchmark. Oh, okay, this company went for this, or this company went for that. That sometimes can go can cut both ways, because like sometimes people are like, oh, I'm building like, and this isn't to like pick anyone, it's just the example that just comes off the top of my head, like, oh, I'm building the Plaid of Africa, right? What was Plaid valued at when it was the early stage? And then sometimes that may be instructive, that may not be not so instructive, because like sometimes there are different funding dynamics at play. I tweeted about this like actually like yesterday, where I think there was there was like a chart floating around like the industry. They're like, oh, valuations have changed X amount of time. The time to exit or the time to liquidity has changed a lot. And I was like, are we comparing it to apples, right? Because like if a founder, raises from like an exclusively US investor base, right, they're immune to a lot of things, right, happening here in Africa. So like there are some, startup ecosystem that like the funding round dynamics look like American companies, clearly. And you look at a cap table and there'll be like no African investors whatsoever. Or like you have startups in the ecosystem where like the funding dynamics are shaped by like, oh, a Chinese capital base fully, right? Where they kind of define a lot of the odds. You see, oh, $200 million Series A is a one, right? If John Doe goes out and tries to raise for her business, like likely not going to see some of those things. So benchmarking is kind of, it's subjective, but I think as we kind of have more and more recent points in our market, that kind of becomes a bit easier. And then on the investor side, I think at the end of the day, I think valuations is very much so, because I talk about it like a supply and demand construct. On the demand side, you have the investors come from walks of life, right? You have like angel investors. Okay, you're weighing this as an opportunity costing. Okay, well, I could put money here, or I could put money and save for retirement, etc. I tend to think of investing from Ed's lens as based on your opportunity cost, right? So if you're an individual, your opportunity cost is maybe like, oh, okay, what you would get if you put money in your savings account. So if you invest and you make 50% profit, like you're thrilled, right? Or if you make double your money, you're thrilled. For So for example, for a VC, you know, let's say you go out and you raise like, I don't know, like a $10 million fund, right? And, I would say these days, limited investors in venture funds are looking for roughly at least 5x return. So it's like you raise a $10 million fund, and over the life, you expect it to turn 10 million into 50 million, right? And when you kind of think of that, then your bar for investing and your appetite for valuation is shaped by that, right? So like one thing that I always say is like every time an investor makes an investment, professional investor, what I call an institutional investor, I like they raise money, a set of people, a set of like limited partners per se, are looking at underwriting investments based on, okay, how will this kind of move the needle towards that target objective, right? So very often you see some VCs, like in proper institution VCs, look at things and ask themselves, well, okay, if I can't make at least like a five times me on the base case, then it's not worth my time. And that gets into, and that kind of really helps shape how people's tolerance around valuation, at least from that construct. And so, I mean, that was a lot there. Just kind of about like, so we touched on the investor side of it. We touched on, how as a founder, you can kind of think about, establishing a valuation, right? Whether based on like benchmarks, and also too based on how much ownership you want to sell in the round. Then I think the other component of another way to think of valuation, at least the way I kind of tend to think about it, especially when you're looking at pre-seed, very early stage businesses, is that it's what you're really trying to assess is momentum, right? Like analogy, like how can you get from first base to second base and a second base, third base, right? Because I think in building a startup, it's a series of hypotheses tests. Like, okay, I'm going to go out with this thesis and I'm trying to see if it can be valid. Test comes back, positive. Okay, then let's kind of, refine and build this up. Test comes back. Okay, no, you try another test, and you kind of repeat that process over and over again. Now, in terms of when you're thinking about outcomes, right? What this ends up looking like is if you were to kind of plot a chart of like what outcomes look like in terms of like, okay, acquiring market share, becoming a unicorn or whatnot, you find that the life of a startup is never like linear. It has all these different mutations. And what's really interesting about it is because you can kind of start to kind of think about it in terms of scenarios. If this goes well, scenario 1, scenario 2, scenario 3, scenario 4, scenario 5. And you actually find that like a number of like large C's model in this way. Like for example, like a recapital, like we model in this way. Like we'll run statistical. So our modeling doesn't really look like a discounted cash flow analysis or whatnot. Like just most early stage companies just aren't much enough for you to start thinking about predictable cash flows. It's more an exercise in, okay, well, what do all the different scenarios look like? And it's actually more of a statistical analysis. Oh, okay, like you could eventually, the company could go to zero. That's one scenario. The company could grow but become a niche player in the market. That's one scenario. The company could grow big, but find itself as almost kind of like a doing okay in a large segment. That's one scenario. And sometimes you still run like what we call in industry like Monte Carlo simulation to assess a number of different scenarios, and they'll probability weight them. And in probability weighting them, you're getting a base case. And now once you have a base case, you then think about, okay, what is my return objective? Let's say, you have a 5x return objective. You take that future, you take that kind of base case scenario and you divide it by that return objective. Okay, this is what I can afford to pay at valuation at the top end. That's a more scientific way to think about it. And that I would say that method is more common in like the US versus like the African market, at least today. But like when I look at things, that's kind of how I tend to think about it. Like deals that like we're very serious about, it's gone all the way. We've kind of sat down an investment committee and thought about it. Those are some of the things that I'm like looking at and presenting. Like, okay, from a risk perspective, how do you kind of manage
this? Just a quick question around like just angel investors. Obviously, like sophisticated VCs, like they have their models. What I'm really keen to understand is like, here I hope we have a lot of people who are investors in their own right. Like, how should they be looking at this, right? Yeah, and I don't know if you don't even mind touching on like stages. Because what we do, I mentioned earlier, sometimes we do angel rounds as high as Series A, and what should they be looking out for? I think personally, I have my own thesis as well as bringing it to the community, but I'm keen to maybe get some inputs to maybe help the community about how they should be looking at valuation.
I think 9 times out of 10 there's a positive correlation between valuation and market size, addressable market size. And I think the way to kind of think about like more frankly is just that the bigger the market size, the more room you have to maneuver as a business, one. And if you have more room to maneuver as a business, right, even if you kind of like trip and fall, right, you still have an opportunity to capture a sizable market. So like one thing, like for example, that like I always say like is a red flag or like a disconnect is like, okay, if the valuation that you're underwriting to, if the valuation that you're underwriting to is for a business that has like a limited total addressable market. So like let me give an example. At pre-seed, right? I wouldn't pay $10 million value in for a business that has, $100 million addressable market. To me, I think like when we look at things today in pre-seed, in the African landscape, like 8 million valuation is on the high side of things. Like it better be like, the best of sliced bread. At least the way I think about it, like, cause like I have to, the investment committee, I have to like justify this too. And I think like as an angel investor, that's one of the first things that you're trying to assess. And, like the other thing too is just like, I love founders, like, but I think also too, like in pitch decks, like you see, this total addressable market. I think there's like quick, easy homework you can do to validate some of those things. And like, okay, like, our fund, like we do bottoms up and top down analysis. Like, okay, like let's see how closely does this corroborate. And I think the other thing you can also kind of think about too is just looking at how big the opportunity can be. Like sometimes like looking at like comparables in other markets can be instructive, sometimes not so much. Like I'll give an example. Sorry if like I keep going to like fintech because like I spend most of my time in fintech and digital commerce these days. But like banking as a service, for example, right? Like if we're looking at like comparables in the US, right? They look really big, but at the same time, I don't necessarily know how well one could kind of like index on, like for like someone could look at like you know, are doing banking as a service and say, oh, well, you know, market in the US is really big and it's this big. But then I think sometimes there are other like nuances that you need to kind of account for. Like, for example, like, you know, in the US, card penetration is really high. Banking as a service is largely card driven, right? Whereas, you know, card penetration doesn't look as the same in Africa, right? So it's like when we think about how big this could be ultimately, right, we need to kind of take things into account. So that's why, like, you can think of like, you know, what a similar business in a different market and how big it is. But like, I sometimes like, actually, I think the best comparables to say like, okay, how big is it gonna be? It would be like, how big is something like this in like another emerging market? I think those are better and closer comparables. Like, okay, like I spend a lot of time like to like, you know, and just looking at comparables in like Latin America and the Southeast Asia, right? I think like, for example, like, you know, I'm giving another example, like a company like Kipper, like you look at Kipper and you're like, oh, okay, this reminds me of like a cat in Southeast Asia, right? When we think about some of the demographic profiles out there, okay, this, you know, I can start to kind of wrap my head around valuation in that sense, and I kind of think about it through that prism. Yeah, that's if I were an individual investor, and actually like I will invest myself too, the way I rationalize valuation is really just about like how big could this be, index on, you know, comparables, and then also to I think about market dynamics in that respect, and also to what is a tenable, like what return would I be happy with. I spend a lot of time thinking about that upfront. Like as an investor, like if I make double my money, like, and you know, and maybe this is me, like I have a more like conservative lens with it. Like I always typically like budget for like double my money. Anything more than that, you know, that's phenomenal. So like, you know, I always kind of think about it through that lens.
Peter, just on that particular piece, like one thing that we say at the, you know, at least in our documentation is, you know, like members, we think that, you know, the deals that they invest in, we don't promise, obviously we can't promise a return, but we're looking at, you know, I don't know, 2 to 3x over X amount of period. Like on your side, especially when we're talking about like angel investing, like especially at the early stages, like what do you look out for in terms of when, you know, you should be looking at an exit? And again, I'm gonna partially answer the question because, you know, you raise a 10-year fund because you expect to kind of deploy and harvest in a 10-year period. So you should kind of give it 10 years. However, you know, there are so many things that happen during that period.
Oh yeah, 100%.
So like, you know, 100%. What do you, or what should people be looking out for in terms of expected return time?
Expected return times? Yeah. I think as an angel investor, I think your expected return horizon probably most likely looks shorter than traditional fund. Right, like whereas a fund might wait, you know, 10 years, in some case even, you know, with like additional 2-year extensions thereafter to kind of realize their return. I think as an angel investor, once you kind of into like growth stage, like Series A world, you're kind of in a land. And I'll explain why. I think especially like in Africa, so I guess I'll preface it by saying this. In the Africa tech ecosystem, I think we're still relatively young in the sense that like a lot of people, their first funds, a lot of people are just kind of starting out doing VC. So, you know, I would say like the dynamics that we see amongst like local VCs still look very different from like how it looks in the US. So what do I mean by like, there are a lot of people writing what I would consider like smaller checks. So like there's a lot of 25K, there's a lot of 50K checks flying around. And there isn't this in focus on ownership, right? For the average US fund, there's a very strong focus on ownership. There are a lot of funds out there that like, if they can't take, 12, 15, 20% ownership, they're not even, there's no conversation to be had. Mm-hmm. And I think this kind of comes to a head, especially at Series A level and onwards. Because like, if like a Tiger Global, you have an ownership target that you got to hit in one way, shape, or form. Where that's a good thing for angel investors is that I think, let's say, just going to throw out like a hypothetical, like at an average Series A round, maybe about 25% ownership being sold. If you're a big fund and let's say you need to have, 15% ownership, right? And there are a couple others that kind of co-invest alongside you. Likely isn't enough room in the round for you to hit your ownership target. And that's where this interesting thing around secondaries comes up. Right? It's basically existing investors might be offered the opportunity to kind of take a buyout, at a slight discount to the round, but, a buyout nonetheless. So, and I think this happens with much more frequency at like a Series B and onwards. And I think, that, and oftentimes you see a lot of angel investors kind of gracefully bow out. Also, too, I think it also marks a turn in just the kind of fortunes and trajectories. I mean, you could look at it like a flutter wave, for example, right? A flutter wave precedes like 2.5 million valuation. Yeah, flutter wave.
That's like a 1,000,000 X's. Obviously.
Yep. Right, and then like, so for example, like at the point of the Series B, right, the Series B happened at a billion valuation. Secondaries traded at somewhere on like 800 to 900 million, right? You saw a lot of angel investors, they took their bow and and kind of moved on and wished them the best. And a lot of secondaries are trading hands to the new growth equity investors coming in trying to buy their ownership. So I think we in the ecosystem today, I see a lot of angel investors kind of like liquidity as fast as 3 years, some 4 years as well. With growth with foreign investors coming down the line, where I think they're going to be doing much more seed as well. I think maybe that timeline continues to compress down a bit. And I think it's a phenomenal time to be an angel investor, kind of putting forth risk capital, because the way that we also kind of think about it is that like for anyone that's like a very like big finance person or like follows like the stock market, is like the whole concept of like the capital asset price model, right? Like you have a discount rate for a public company. For public companies, we see the discount rates in the US somewhere in the range of like 15%, 20% or whatnot. The way to almost kind of think about it, it's a quantification of risk. You first start as a startup in your journey, the failure rate is super high, and that discount rate looked like 90% at pre-seed. And as you kind of, and that's why I think of like startups as almost kind of like you're kind of like it's almost like a game of baseball. Like you're getting into first base and you get into second base to and it's like as you kind of hit each base, your risk drops. So you're eventually, as you move closer to IPO, your risk or discount rate converges with what you would expect to see of public companies. And the way I was kind of thinking about that, okay, well, if you're thinking about it through that lens, any money that you put up front carries that high risk, that high risk. But also to at a time, that risk is commensurate with your return. Mm-hmm. Right. And I think that's what's so magical about investing in early stage startups. But yeah, I would say A round, Series A and onwards, that's where most angel investors will see a lot of liquidity.
Awesome, Peter. I'm very conscious of time, and I know we only scheduled this for a half an hour, but I hope that you can give us, at least the community, an opportunity
Oh
to
yeah.
ask one or two questions, if that's okay.
Oh yeah.
All
Yeah.
right, I think we have the first hand up, which is Dozy. Do you wanna maybe if you can remove your camera, if you can put on your camera, that would be great, and go ahead with your question.
Yeah, thanks. Hi, Peter. Thank you for the
Hey.
presentation. You mentioned the Monte Carlo simulation, and that just I'm just reliving the trauma I had in university from taking a class on Monte Carlo simulations. Yeah.
Yeah.
So I
Yeah.
have two questions. My first one is pretty easy. Do you have any books or materials or websites or any pages that you recommend that you found useful in terms of like valuations and startup investing? And my second one is a favorite question I like to ask anyone is with the interest that we've seen in the Africa space of startups, how do you envision the valuations going forward? Do you think that there's a bubble, or because there's a lot of capital, like just like everybody wants to get in, that they see this as the next great opportunity? Do you see a bubble forming? And like, I just wanted to hear your views on that. Thank you.
Yeah, sure. On your first question around just like some stuff you can read, I think I think like the book I recommend like everyone kind of take a look at and just kind of familiarize yourself with is Venture Deals. I think Venture Deals really speaks to a lot of like the core like fundamentals that kind of like shape the industry. It's a great book. It's a great book in general. Brad Feld that wrote the book is actually one of our limited partners of the fund. And I always just kind of say that like for every new hire we have at the fund, like it's like the Bible. Like that's what you read, that's what you skim through. And I think also too, it also kind of helps you crystallize the dynamic around just like supply and demand. Because one thing like they spell out there, because it's written from the perspective to help founders, and like one of the things like they tell you there is just like as a founder, your job is to get as many term sheets as possible, right? It's like this whole concept of like driving up demand, right? Because that's you kind of you best position yourself around valuation, and that's why like even in the system you see people do like safes at multiple valuation caps, driving demand. And I think other books really as well. I mean, the stuff that I read was mostly like boring accounting guess. There are a number of different. Actually, there's a paper actually by out of Harvard that kind of authored one of the most prescient quantifications of risk in industry, which was kind of it's called like V-rates of return. And it kind of gets at this idea that the discount rates, as you hit these more advanced stage of developments, should be falling, and I think and that's based on a real observed study. So it's not like, okay, like just take my word for it. Like it's helpful to just kind of skim through. Like I wouldn't recommend reading the whole paper, but like there's the abstract and also to the charts are like super helpful in terms of just kind of understanding that. In the current state of valuations, do I think it's going to be a bubble? We'll see. Okay, yeah, I'll put the name of the paper into the chat. And yeah, I think with respect to valuation, is it a bubble? It's hard to say. I think of it, there's almost kind of like two dynamics at play. You've got public markets, right? Where like, okay, public market, tech stocks are trading down on the public market. It looks like a correction in play. I think those things work to tamp down growth stage valuations. Like I think that's logical because like growth stage companies are like the closest to, right? Going to IPO, and if the public market is saying something different, right, in terms of like the value being placed on these companies, then it kind of goes without saying because they're the ultimate buyer. So I think that compresses valuations down. In Africa, the early stage, my personal theory, at least, like I'm in the process of raising a fund too, and like, the way I've done the fund modeling around that is like I expect there to still continue to be valuation creep, and my theory is kind of driven by two things. You've got like a Tiger Global out there that's like investing at this very rapid, fast pace. And, I don't know how much like people follow this, but I think, I'll put it like this. Every fund has, a return objective and return target. Tiger Global is playing a very different game. High velocity, and they're actually taking a lower return objective than almost all of their peers, which is allowing them to push up the valuation, because venture ultimately is a game of, and that's why you see it's high velocity. They're throwing more dollars, and they could drop the return objective a bit. With a lot of that upward pressure, I'm not so sure how. I think valuation remain elevated. At least I think within Africa, because I think a lot of capital can flow in, and I'm not sure if you guys saw, but like Tiger Global, recently announced that like they're doing A and B rounds only. Like they're not touching late stage anymore. A and B rounds, and they're going to do, and they'll selectively do seed strategically, but also at the same time pumping money into down market funds, right? So like I think also too in Africa is like you've seen this influx of capital, and there's a paradigm shift at hand. I call it. I think like in any industry you go through waves. I describe it as the shift from VC 1.0 in Africa to VC 2.0 in Africa, right? And like I don't mean anything malicious by like saying some of these guys' names, but I'm just like, whereas like an African Invest or like a Novastar were like kings of VC 1.0 in Africa, right? They find themselves in a very different world in VC 2.0. And you're going to see a lot of these guys move down market. And what that's going to do is like, because again, VC's magnitude is very driven by magnitude. So if you're like, a Corner Capital or Flourish, right, and you feel pressure from like, a Code 2, DSC, Tiger Global, etc., at Series A and whatnot, and you decide I'm going to pick my battles and go down market, well, that fund economics have a constant at play, right? A Corner Capital is a $200 million fund raising another mega fund. They have to deploy a certain amount. They can't, like anything less than $1 million check, it's not worth their time. So now you have more capital being targeted, right? It's valuations are only gone, it can only go one way. So I think at the early stage in Africa, I think valuations remain high. You have local VCs now to move on to their second fund. Fund economics change. When you hear local VCs raising, $40, $50 million funds, that capital has to go somewhere, and you got to write bigger checks. And there's a direct correlation between round size and valuation. And I just see a lot of pressure just kind of keeping the valuations up.
All right, thank you.
Thank you for that, Peter. Again, very conscious. I just feel like we needed more time for this because we could be here for ages. I've got so many questions. But again, like Peter and I can speak another time. If anybody else has one more question, please unmute. You can, if you want to, go on camera and take it away. Well, Peter, it looks like we don't have any questions. Well, I want to thank you for this time. One thing that before we wrap up, I just want to say to everybody on this call that angel investing is a very risky asset class, and you can lose your money. So please, invest, wisely. Make sure you do your research, read the documents we provide. If you're not sure, ask more questions, and please, please, please do not invest any money that you're not willing to forget about or lose. As Peter said, it can be 3, 4, 5 years before you actually see any return on that money, if any. So, Peter, I don't know if you have any closing remarks, words, before we wrap it up.
Yeah, no, I mean, appreciate you having me do this session. I think, one of the reasons I kind of got into the VC ecosystem was because, I had led a career, frankly, where so the people around the table getting incredibly wealthy didn't look like me. And I felt like, okay, like, making a good living and whatnot. But I'm just like, it sometimes it weighs on your conscience a bit. And I think what's really remarkable that, in doing this work, we are essentially funding the future in Africa. And one thing that gives me a great fulfillment is just, we're seeing, who found look like us building, great scalable businesses. And there's a whole sub economy around, right? It's creating jobs. And I mean, I've seen, what this ecosystem has done to just change people's lives fundamentally, their lives, their families' lives, etc. And, sleep well at night today. Like it's a very different feeling. And I think more than anything, I want more people that look like us to have joy that same feeling, because I think more than anything, context understanding, because sometimes it's just easier, like, being from here or just being from the continent, where, whether you're first, second generation, etc. I think being able to kind of play an active role in helping shape the growth of the tech ecosystem, it's just really, really important that, that we kind of, work to support our own. And, that's my sincere hope for the ecosystem. I hope it only continues to grow in nature. And then I think the real reason why that's really important is that we keep the money recirculating in our economy more broad. Like whether, you live on the continent or in diaspora, there's this kind of cycle that just kind of goes towards kind of building our economy more broadly.
For sure. Thank you so much for that, Peter. There's like one question here, which is from
sure.
Larry. I'll actually answer the second question, and it's, how does one list to raise pre-seed seed at Hoke? Just send us your deck via email. It's hello@hoke.club. And we're actually working on a form that everybody can fill, and we'll review that on a weekly basis. But Peter, the question to you before you go is it possible to evaluate companies based on potential market opportunity, i.e. speculation?
I mean, you can, you can, it is possible. Like, I mean, one thing that's like all age, I think that we see in just VC globally is like, the 50 quick grocery delivery, right? One could speculate on that and say, like, okay, this seems like a thing that a lot of people are super indexed on, maybe you just go out and fund this in wherever it pops up. Like anything, I think it's really high risk. It may work out, it may not work out. And I mean, what I recommend for people is and what I try to do is just, I try to spend my time investing in things that I can, or at least kind of come wrap my head around. Like, our fund, like we have a policy, like if you have a deal, you have high degree of conviction, okay, you go up there, do the deck, present it to the investment committee. If you don't have conviction that you can talk about it at length for like a 30-minute duration, I think it's something you want to kind of consider. But I mean, to answer the thing more succinctly, right? Can you speculate? Yeah. I mean, like any asset class, you can speculate, right? People speculate on gold, people speculate on Bitcoin, etc.
Okay, that's awesome. I think that's the end. Peter, again, one more time, I want to thank you so much for making the time. You're a very, very busy man. And we hopefully look forward to having you here again. What we will do is we'll download we'll share this recording with the community so that people who are not here can they can rewatch. Somehow it seems like the questions keep coming in. If you don't mind.
Okay. Yeah, I'm sure.
So it's what's the communication frequency expected relating to angel investment in the company? I.e., we get consistent reports from stock investment, but not with angel investment. I mean, I can answer that if I feel free to add. Ideally, you would want to see monthly reporting from like super early stage companies, but at least I hope what we've seen is either monthly or quarterly. And now some founders are really great at sending it, and because it's not listed or it's not regulated.
Joe, it's interesting. Sorry to cut you. I just benefit the time before we go off. But regarding what you say, how investor might feel with the fact that like you can report like, because as a small company you can be like so busy into the business that you don't want to fill reports like every month. But it's something like whether it's like angels or whether it's like VCs and so on, having quarterly, I wouldn't call meetings, but like at least heads up and or PDF report or summary or briefs or whatever we can call it. Is it something like it's totally normal timing wise, and they don't feel like something is kind of dodgy because they report only on a quarterly basis?
So if I understand you correctly, like, is it something that, like, if investors, like, is it something that makes investors feel weird about not receiving reports quarterly?
Yeah, no, about receiving them quarterly instead of monthly, because a month, like, in a startup life goes so fast that at the end of the day, guys don't want necessarily to sit down behind a computer and like doing only reports.
I'm sorry, Ralph. I asked the question. So, do you mind if I combine what you're saying to ask the main question?
Oh, sure.
Right. So, Joey, actually, it's a little bit surprising to me that I've invested in a few things in some Hulk rounds, but I haven't seen these monthly reports or quarterly reports. And so, where are they? And for me, obviously, when in stocks, I know when I get my dividends, I know when I get my annual reports and all that. What is the industry practice with regards to angel investment? Because there are other investments out there, and I want to know what the standard is. And Ralph, from your perspective, I know that startup life is busy and all that, but if there's a standard, then I'd expect for the investment to be returned, for the reports to be returned at that standard, irrespective of whether a startup is busy or not, because you have accountants. So this should be part of the business as usual. Thank you.
Yeah, no, fair. So I think, again, what I was saying earlier is at least at, Hulk, what we've seen is monthly or quarterly frequencies. But again, not every startup send it. The other thing I've seen is a lot of VC funds would kind of add this in the side letter. Now, we currently don't issue a side letter because I think we've only led like one round. So yeah, like, it's something that I think we should definitely consider and maybe add this to like the side letter and make sure that it's send it. Now, if they don't send it, what happens? Yeah. The answer is I don't know. But Peter, over to you.
I could get some around that. You can and should add it to your side letter. It's a standard thing. Like, one should really be no founder should really be pushed back around that. I think my perspective around just like getting feedback from founders. I think I understand the trade-off, and like founders wanted to kind of do it early, but I think at the same time, like, if I think about like the spirit of Hulk and kind of like what it's about, and also to being able to also kind of draw leverage on like the community that includes operators here, right? Like, and like I tell some of our founders, I'm just like, if I don't know what's going on, right, like I can't always necessarily help. And you just never know who people are or who people are actively like talking to, right? earlier this week, like I was on a call with like the CEO of China. Like we've got portfolio companies that like are in doing in like digital banking and whatnot. Like if I'm not aware of a rest of like what's happening, right? I can't plug in a tap in and plug you into that opportunity because like, oh, I may not know if you're ready for it. So I think kind of like monthly updates is a preference. Like I understand like it takes quite a bit out of, but like there are different ways to do it too. Sometimes like there's some founders in our portfolio that like they don't do like, oh, like a whole data dump or whatnot. Like, hey, you know what? Like, you know, once a month, you know, we're jumping on Zoom for 30 minutes. That's, you know, and everyone that wants to, you know, plug into the latest, you know, let's do it. So also at the same time, I don't think it shouldn't feel like a huge lift, but also at the same time, I think as a founder, it's an opportunity also to kind of like hold yourself accountable and also kind of like reflect also too on like, okay, wins for the month, you know, things, challenges, etc. I just think more frankly, like, you know, as a founder, whoever you're taking an investment from, once you've taken that investment, you all have a vested interest. We're all in the same boat together, right? And I think it's really just like, it's a great way to kind of just like ask for help and also put your investors to work, right? So if the communication isn't as frequent, right, then it's like, you're not capturing the full benefit of your investor base.
No, that's exactly what you say, Peter, is because I'm in both situations where I'm investor in Oak, but also I have my own like startup. And I know that like for me, why I ask about the time, giving information back to the investor is totally fair. I mean, that is understandable. What I'm saying is that like, and I kind of understand all the approach that has been said, is that monthly sometimes are so like, I don't see the months going sometimes. And it can be so difficult, whether you have people or not, because you want to focus 100% on the business. And that's why I say like, even in like medium-sized companies that are doing like several, and I'm working at the same time, and I've been seeing the evolution of that. You can see that even multi-million companies do that like on a quarterly basis, because they know that like on a monthly is like impossible, and their quarterly results like have like a month or two delay, which is totally understandable. But okay, that like, thank you very much anyway.
I'm sorry, I'm still not clear on what the answer is, because I asked what the industry standard is. So there's been a lot of talk, but what is the industry standard? And if we have an industry standard, as in we're angel investing via a group, are we expecting that every quarter we will get a summary of what is happening with the company, what is happening with the money? And if that's the case, will we be getting that from Hoke? When can we expect that? If we haven't been getting that, maybe because we think maybe there's somewhere, can we get access to that? Because it's actually really making me hesitant in actually putting any money anywhere else, because it just feels like money is going into a pit and I don't know what's going on with it.
I don't know. Again, I think at the start of the answer, what I mentioned was what we've seen, at least I hope, is monthly or quarterly. I don't know if there's like a set industry standard, but yeah, I don't know if that answers the question directly.
It does, thank you. So either monthly or quarterly, but there is communication, right?
Yes.
Cool, thank you so much, Joe. I really appreciate your time.
All right. Well, Pete, thank you so much. This has been quite enlightening. A lot of learning for me, and I hope for people who are here, and hopefully people who will watch this video. So please enjoy the rest of the day, and I will be in touch.
All right, it was a pleasure. All right, you have a good rest of your day.
Thank you.
You too.
Thank you.
Bye. Bye.
Falake there? Hello? Falake?